There is certainly a lot of uncertainty in our current economy, our property markets, and the global economy. The inflation is very high, much higher than the central banks are willing to admit, and the effects of this once-in-a-lifetime pandemic on our economy and our different markets is starting to show. The potential collapse of Evergrande in China, as well as the Fed possibly looking to start tapering, has sent shockwaves throughout the stock market and cryptocurrency market over the last few weeks. Looking at our local economy, we have Melbourne, Sydney, stuck in extensive lockdowns, and from the look of things, Queensland is likely to follow. These markets are not only the biggest in terms of property values, but also in terms of tax revenue, employment, and GDP output. Consumer confidence is deteriorating, the economy is suffering, business closures are through the roof, and yet we have ourselves one of the biggest property booms in history. Is all of this sustainable? And what should we expect as we head into 2022? In today's video, we'll be going over my top 5 predictions for the property market based on the data that is coming through, as well as the state of our economy. Hey guys, welcome back to the channel. I hope you guys are all doing well and staying safe out there. This is our 3rd or 4th month in lockdown in Melbourne now, and I'm starting to go a bit crazy. I hope you guys are not doing the same and you guys are staying productive and getting things done. Enjoy today's video and remember that this is not financial advice and I am simply sharing my personal opinions and strategies. And I would always recommend you guys to do your own research before investing hundreds of millions of dollars into an investment property. Let's jump straight into the video and start with prediction number 1. This is something I have been talking about on this channel for a very long time now, and that is this level of growth, this level of insane growth is simply not sustainable. So my prediction is that in the coming months and years, we will see much lower levels of growth, not only in our property markets, but also in our stock markets, cryptocurrency markets, and NFT markets. Obviously, 2020 was a crazy year. There is no doubt about it. And to combat such a crazy once-in-a-lifetime experience, the government had to print money out of nowhere to keep the different markets from collapsing. And it could be argued that the governments and the central banks have overdone this because all of that money printing and stimulus has led to one of the biggest property booms in our history. And this will make perfect sense because all of this money being given to us through stimulus and all these different programs and all the cheap debts that the banks are offering us, we can either do one or two things. We can either hold on to it and lose our hard-earned money to inflation, or we can invest it and get a much better return. And this has led to many people simply investing that money into assets such as real estate, the stock market, cryptocurrency, and NFTs. However, we can't expect our governments and the central banks to keep printing money like this forever. And as they start to slow down in the coming months and years, we will see that we have much less debt, cheap debt in the market for us to invest into assets. And we are already starting to see affordability constraints kick in some of our biggest markets like Melbourne and Sydney. People simply can't afford to buy a house anymore. And if we look back over the last 12 months, if you have a nice property in a good location, the chances are you would have seen a growth of between 15 to 20%. This is much higher than the long-term average. If we look at the data, we can see that over the last 40 years, Australian real estate has generated a return of around 7.16% per year. And over the last 70 years, we have seen a growth of around 8.29% per year. Because the growth in our markets over the last 12 to 18 months has been so strong, it is very likely that going forward, we will see much lower levels of growth. And this will make perfect sense because our major banks are also predicting a much lower rate of growth in 2022. This is provided that the Reserve Bank of Australia does not lower interest rates even further. Even though this is very unlikely to happen, it is still a possible scenario because Melbourne and Sydney have been stuck in lockdown for so long and they might need that extra stimulus or extra support to help get them going again. Let's now move on to prediction number 2. Melbourne and Sydney. These are markets that I talk about a lot on this channel, and most of the time it's about how unaffordable they are and how I expect the growth in these markets to slow down. And nothing has changed. These markets are still very unaffordable, and despite the lower consumer confidence and the extensive lockdowns, people are still drowning themselves in debt to get into a property here. So my prediction is that Melbourne and Sydney, due to how long they have been in lockdown for and how weak their local economies are, we will likely to see much lower levels of growth in the coming years because of the extensive business closures, the rising unemployment, and people moving out of these states because the change of desirability in these two locations, especially Melbourne, which has already started to see a huge exodus with people moving out of Victoria and into Queensland and Western Australia, as well as the drastic change that can be seen in the CBD, where retail vacancy rate has shot up to almost 13%, a massive jump from the 3.7% recorded just 2 years ago. Instead of seeing trendy cafes and nice retail outlets when we go for a walk in the city, all we see now are massive for lease signs on vacant properties. As our extensive lockdowns continue, more businesses will close, more people will lose their jobs, and the overall devastating effect in our economy will compound. All of these factors will have an effect on our property market, and this is likely to lead to lower growth or even a period of stagnation or negative growth. Let's now move on to prediction number 3. And that is, in the coming years, cash flow will become more and more important. And here is why. There are two types of property investors. Investors who invest in properties that are negatively geared, which simply means even after they receive the rental income, the property will still require the investors to contribute additional money towards the mortgage, maintenance, and the outgoings of that property. And then there are investors who invest in properties that are cash flow positive, which simply means the rental income generated by renting out that property is enough to cover all of your expenses and repayments. I'm not saying one is better than the other, and there are definitely benefits for both. However, as growth starts to slow in the coming years, and as interest rates and repayments start to rise, the investors who have cash flow will be in a much better position to service their properties as well as grow their portfolio. Right now, both types of investors are very happy because even the investors who are forking out hundreds or even thousands of dollars towards a mortgage every single month, they're still happy because they are seeing such strong growth in their property. However, over the next few years, as that level of growth slows down and as their repayments start to increase due to interest rate hikes, it is likely that they won't be so happy with the investment anymore. On the other hand, investors who have a very strong cash flow will have no issues paying their mortgage because after all, it is not them paying the mortgage, it's their tenants paying it. And all of that surplus cash that they are receiving on a monthly basis can be used on a deposit for the next property, so they can take advantage when the market is not as competitive as it is now. Just think about it. When you have a negatively geared property that is draining you hundreds or thousands of dollars every single month, and as your repayments increases, you are going to be very stressed. You are not going to be in the mood to buy another property. However, if you have a property portfolio that is cash flow positive, all of that surplus cash can be used to purchase your next property. Especially when the bank is only offering 1% return on your money, it will be a much better idea to invest that money into another property. That's why I think cash flow will be very important in the coming years as our repayments start to increase and as interest rates start to rise. And the investors who have strong cash flow will be able to take advantage of a less competitive market and find much better deals. That's certainly what I plan on doing. Let's now move on to prediction number 4. And that is all about government policy towards the property market and how that is likely to change in the coming months and years. As we already know, the Australian government has a love affair with property, and they will do everything they can, including throwing the kitchen sink at it before letting it crash. And we have seen this over and over again. Back in 1990s recession, back in the 2008 global financial crisis, and again last year when COVID happened. The government's policy towards property is no doubt a very favorable one, and they have done everything in their power to keep the markets strong and growing. Because a strong housing market encourages consumer spending, it improves consumer confidence, and it supports jobs in the construction industry. When a property owner or property investor sees their investment property grow by 20% a year, they are going to be very happy and they are going to feel very wealthy, which is going to lead to them want to spend their money on a new car or even buying another property or even just shopping. And this is good for the local economy. However, will the government's stance on property change in the coming years as our economies recover and as we head out of lockdowns? Or if the Liberals lose the election. My prediction is that the government's stance on property is going to change in the coming years. They did everything they can to prevent a total collapse of the Australian economy, because we all know that if the Australian housing market crashes, so will the entire economy. However, now that the property markets have seen a growth of almost 20% over the last 12 months, will the government continue making this bubble bigger and bigger? My guess is that in the coming months and years, the government and the Reserve Bank of Australia will start changing their policies to slow down the property market. Obviously, they're not going to increase the interest rate by 2 or 3% overnight and crash the market. They are going to do this in a very subtle way that achieves a soft landing. Look, I know this sounds a bit bearish, but I personally would much prefer seeing a growth of 6 to 8% instead of 20% a year, because this lower but much more sustainable level of growth is not only healthier for the property market in the long term, it will also give investors a return that beats inflation, and it will also significantly reduce the risk of a major property crash later down the track. Alright guys, I know the first 4 predictions make it sound like I'm not very bullish on property and that I'm not expecting too much from the property market in 2022. But that is not the case, because I am expecting certain markets to perform very well in 2022. So prediction number 5 is that there will be certain markets that will perform extremely well. I will start by saying that I do not have a crystal ball and that I cannot predict the future. In fact, nobody can. If someone tells you that they can predict the future and know exactly where to invest to get the maximum growth and how much growth they are going to achieve, they're either lying to you or trying to sell you something. Often, it's a combination of both. I do, however, focus on the fundamentals and the data to put the odds in our favor. If the property market is at the very bottom of its growth cycle, it is likely that this market is going to see a longer growth period compared to some of the other markets that have been growing very strongly already. If the market is not so unaffordable that people have to drown themselves in crippling debt just to buy a property, it makes that market much more healthy and more sustainable. And if the market has a very high median income and the housing there is still very affordable, then serviceability will not become an issue, even when interest rates do rise. I'm sure a lot of you guys already know which market I'm talking about, but for those that are new here and you haven't been watching my previous videos, then I would like you to put down the answer below in the comment section which market fits all of these requirements. Alright guys, this brings us to the end of the video. I hope you guys enjoyed it and that you guys learned something new. If you did, please do me a huge favor by hitting the like button right there and subscribing to the channel and commenting your thoughts. This really goes a long way in supporting this channel. I hope you guys stay safe and productive out there, and I'll see all of you guys in the next video.